Hello everyone. So today we are going to explain put options in the simplest way possible. Let's start. What is a put option? A put option is like insurance. You pay a small amount today, and this amount you already paid protects the value of something you want to sell later. Now we are going to use a real life example. Think of phone insurance for a $120 phone, and this insurance is valid for 30 days. We have two scenarios. Scenario number one: 2 weeks later, the phone value drops to $100. Everyone else sells for $100. In this case, you win because your insurance let you sell that same phone, which now is for $100. You can sell it for $120, even though the market price is $100. You just made to $20 and protect it. Scenario number two: 2 weeks later, the phone value jumps to $150. You simply walk away. You only lose the insurance price because why sell at $120 when the market buys at $150? You sell at the market price and only lose the insurance cost. Maybe let's say you paid $5 for the insurance, the put option. Maximum loss is $5. Your potential gain are big but limited to the strike price. In trading terms, the strike price equal $120 locked sell price. Expiration date 30 days, the deadline for the insurance. Premiums are the insurance cost. So why we buy a put option? We buy a put option because we believe that the stock will go down, the price of the phone will go down. So we pay a small amount right now, the premium, the insurance, to lock in a high sell price in the future. When do we make profit from this put option contract? If the stock price, the phone price, was less than the strike price minus the premium we paid. So if the stock or the phone price drops from $120 to, let's say, $100, and we also pay $5 for the insurance, our profit will be $120 minus the $100 today's strike price minus the $5 the insurance price, the premium we paid, equal $50, and that's our profit. When do we lose? We lose when the stock stays at or above $120. Our maximum loss is the premium we paid, and we will never lose more than the insurance cost. So, summary for put options: we have the right to sell, we want the price to go down, and our loss is limited on the premium cost. We can make big gain up to strike price, and it's like insurance for stocks. So now we are going to make an example. We will open SPY ticker symbol, and we will see that we have multiple strike prices. We will use the 27th of April. We go down, and I think the price will not go below, let's say, 719, as you say, 7, yes. And as you see, I press on the market price, and as you see, the cost we are going to pay is this 1,500, and we will not lose anything more than this cost. And that is, in a very simple way, the put option contract.